Longevity Capital is an institutional merchant bank that provides venture loans to clients of leading investment banks, advisors, and also venture capitalists. Now, the idea here is to help fund expansion for the next generation of growth companies. So here to explain more about this very unique investment vehicle, I've got Stephen Moore, board member, economist, also John Beyer, the CEO of Longevity Capital, and Doug Anderson, the CEO of Wall Street Capital Partners. So great to have you guys here.
Thank you.
Yeah,
Thank you.
John, let's start with you. So this is a unique business model. It involves life insurance collateralized bonds that are called yes bonds. So explain to me, what is a yes bond?
Well, a yes bond stands for a yield-enhanced sinking bond, which is kind of a mouthful.
Okay.
But basically what Longevity has done is we've developed, over the course of a number of years, intellectual property that allows us to acquire longevity-based assets, primarily life insurance, and to build it into large pools, which gives us predictability and allows us to back a fixed income security, a bond, and to do so with high predictability and tremendous return for the bondholder.
Okay, and so this is a way that you're working with venture capitalists to find whatever, the next Facebook, to be able to help fund this and participate in the growth there?
So in fact, the concept of this is that the primary asset pool are these longevity assets, which allows a long-term investor to get their money back and to get a reasonable return on it. And then we carve a portion of the funds, a minority portion of the funds, and make a venture-type loan with it, which has warrants associated with it. So the investor has the capability to be able to buy an investment-grade fixed income security, know that they have the level of lack of risk that they're going to get their principal and their return back, yet still make a bet looking for the next Facebook.
Yeah.
And so they can sort of take a flyer in an equity-like investment while having the benefit of a fixed income investment.
Okay. Now, Steve, you're a board member, and when I was kind of going over all the materials this morning, you know, I thought a little bit, this is complicated. You know, is it kind of financial engineering? Does it remind me a little bit of the recession? I mean, how is this safer? And I know technology is one big part of that, but how is this a safe investment for people?
So first of all, you know, the reason I got so hyper interested in this product, because I've never seen anything quite like it before, you know, what you've created, is, you know, and we've talked a lot about this, you can't make money in bonds today, right? I mean, you know, what are you going to invest your money and, you know, get a 2% return on a bond? I mean, you might as well just, you know, put it on your mattress or something. And what's really, I think, unique about this product is that it is a safe investment, but we're talking about returns that'll be significantly higher, right, than a traditional bond. And that's what makes this, you know, the combination of safety and security based on your actuarial assessments of these life insurance policies and getting a return significantly higher than you can on a traditional bond. So where else can you find that?
I mean, it's really, you know, interesting and kind of innovative.
Well, in a very simplistic sense, what you get is a high yield-like return with an investment-grade rated security.
Yeah.
And I've not seen anything quite like that.
Why has nobody thought of this before? So
we finally found that needle in that haystack.
Yeah, so,
or the piece of gold.
It took a while.
Yeah, okay. Now, and Doug, I always like kind of get your like big picture, like macro view on these things. So, I mean, like, why do you think this is so important and maybe even, you know, a new kind of very key investment vehicle for people?
You know, no one's been able to do this before. Some people have come close, but they've always backed it with reinsurance or a bank. And in this case, they've done it on actuarial skill. They've figured out how to select these contracts, pool them, and crack that nut and get a BBB plus rating, investment grade rating from this. So it's very unique and it's groundbreaking. And I think that you're going to see these things sell like hotcakes into the market because everybody's going to want this kind of instrument in their portfolio.
So it leads me to the next question then. Can an average person participate in this? How does all that work?
Well, they're currently sold through a form of a Regulation D exercise, but we put them through a series of tax benefits in Ireland, And we believe that somewhere around the 12 to 18 month period, we will be able to market the pool of policies or the pool of assets in excess of the value of the bond, at which time it can be listed on international exchange.
I see.
We'll get what's known as a QSIP number, and will become a publicly traded bond at that point. So bond investors, while they take some risk at the initial stage, most likely will have liquidity after several years.
Okay. And then there's about, what, $4 trillion worth of life insurance in people who are over the age of 65. So that's a huge market and a liquid market, I would think.
Yeah, we're not going to run out of policies to look at.
Well, that's
significant
true. And
inventory.
the demographic trends.
And you know what I like, what I would recommend to people is make these bonds part of your portfolio. You want to have a diversified portfolio, for your own retirement. So these are the kinds of bonds that will give you a higher interest rate, a higher return than you would get on a traditional bond. I'm not saying you don't want to also have traditional bonds in your portfolio, but these just really make a lot of sense in terms of getting a higher return.
And John, explain the technology behind it. You've got software that mines a lot of data and reduces risk?
Yeah, the primary intellectual property is we have spent many years developing basically mathematical modeling that allows us to be able to acquire, manage, and very importantly, continually revalue these large pools of longevity-related assets. Something that is quite important, requisite to what Steve had just mentioned, is this is a non-correlated asset. So this is not tied to the economy of any particular, commercial sector. It's really just to longevity. And so it becomes an important piece of a person's portfolio or any institutional's portfolio in that way.
And Doug, how would the demographic trends, Americans are getting older, living longer, how does that play into the success of this?
Well, what I think is unique about this company as far as the huge upside is the fact that they're taking the proceeds and they're making loans to emerging high growth companies. And what that means is for the company, it's got a huge upside now. Why can they do that? Because they can afford to, because they're making such good returns on the assets that they've selected. And as far as how they select those and the trend that you're talking about, it's math. They've got actuarial scientists that for fun play three-dimensional chess with a blindfold on, so.
When I first heard of the product, I was surprised that no one had actually done this before. You have the actuarial. How many years of actuarial experience do you and your partners have in this? The experts,
many decades. But it's but the specific work on this, is approaching a decade now. And what we have been able to do is this is massive number crunching and massive analysis that we can go to a rating agency and we can prove to them with very little doubt that at the worst case, it's still going to return the principal and the minimum interest, yet someone gets this tremendous upside in there.
But you still have, your risk reward is favorable.
The company actually emanated out of, I was mentioning earlier, a conversation at a bar in Tokyo 14 years ago when we were speculating and saying, how could we get to institutional type capital that normally goes to venture capital and deliver them a fixed income type product that could funnel some money to the corporate sector, to emerging companies, and effectively show that. And that's the premise of the company.
Okay, so where are you with the company in terms of 2020, getting ready for the new year? What are your goals?
We are just issuing our first bonds right now. We have commitments on our first several, and we are tremendous interest from others. So we're hoping in next year to issue a number of these bonds.
Get it going. Okay, thank you so much, and best of luck to you. Thank you, Steve and John and Doug, for coming in.
Thank you.
Yes,
Absolutely.
and thank you as well. We'll be right back.